everybody, I'm Jer. Welcome back to my YouTube channel. I want to talk to you about the crazy situation that is a stock offering, a public stock offering. For those of you who have experienced, you know exactly what it is, what it feels like. It's horrible. Horrible. It's horrible. It's horrible. It's horrible. It's horrible. But it happens, and it happens a lot. So you should know it happens before it happens to you. It usually will happen. Usually news of a stock offering will happen before opening at 9:30 a.m. or after hours after 4 p.m. There's an announcement made by the company, SEC filing, that says, hey, we're going to do an offering. So what is an offering? An offering is whenever a company issues more shares of a stock for sale. Now, why does that matter, and why does it mean that people are going to sell and you're probably going to see a drop in the stock price? Why it matters and how it causes the stock to drop in price is that they are adding more shares, doing a public offering to your stock. So where a company once had maybe, let's use 10 million, had 10 million shares, they can then do an offering for 5 million more shares, or however many more they want to do. There's probably regulations on it, but let's say they do 5 million more shares, then obviously you're going to see the stock price drop because now there's more shares to compete for that, basically for that market cap, for the total of the company worth. So whenever a company announces that they're going to do an offering, you'll often see the stock prices go straight down. And it's like, what's happening? It's because news came out that the company was going to do an offering or has completed an offering of so many shares, meaning that the company value is now split up to even more shares being offered to more people, bringing the individual stock price down. People get news of it, and then they get out, which also makes it drop even further. So that is what an offering is, a public offering. Now then, they can that's offering shares to the public for a certain rate, or for at the market, ATM, which is like saying they can do an at the market and say, instead of issuing just a set number of shares, they're looking to raise a certain amount of money. So a company that is worth, let's say a company is worth $100 million and they want to offer 50 million in shares at the market public offering. So you're going to see probably the price of wherever you're at. You're probably going to see if they have $100 million, if they're a $100 million company and they're trying to raise $50 million on top of that $100 million, then most likely you're going to see the stock price go to about half of whatever it is, because you're adding half of whatever the company's worth. So if you're saying that, this is kind of a little bit harder to explain, but if you're saying that you want to make 50% of what your company's worth in an offering, then it's likely, even if you're doing it over time, it's likely to bring the share price down by about 50%. So it would have to be like 50%. So you have 100 million, 50 million added to that, or taken away from that, basically, because that's what they're doing. They're just taking money away from investors, from the from the shareholders, to then use to do just normal operations, to pay admin fees, to sometimes to acquire another business, to buy other businesses, to buy different products that they need, or maybe different different equipment, or software, or whatever it may be. It may be an investment into the company, but they're doing it at the expense of shareholders. So obviously you're going to see your share price go down because they are basically taking money from the pot that's there. So they'll go from $100 million company. They may still maintain that $100 million, but now there's going to be more shares. So if there's more shares added to that, then the share price is obviously going to drop. And so you're going to see probably a drop from that. And it all depends on how they're going about the offering. Sometimes they don't do a public offering, they do a placement with an institution and say, hey, we're going to sell you, like 10 million shares for, let's say that the company is currently trading at $5. Well, we're going to sell you, well, actually, I'll use an example of this in a minute, but we're going to sell you 10 million shares at a discounted rate of $3. And so those 10 million shares are added to basically the pile, the free float, the shares outstanding, which in turn brings down the stock price, usually to whatever they offered it at, like the $3 or below. So you goes from 5 to 3, which is a big, big setback on stock price. And then whatever they use that money for is up to them, or whatever, depending on the filing. So it could be basically anything, which sucks. So let's go. All right, let me check this real quick. Set this up, and we will go and look. I will show you an example. Let's go to Robinhood. All right, so the example. PMCB. This is one that I got burned on horribly bad. And I learned my lesson. And my lesson was get into stocks. Feel free to get into stocks during the day. But if you don't know the company, if you're just planning on trading the company, like just a quick trade, then I highly suggest getting out before the end of the day. Because at the end of the day, they can do an offering a lot of times and it will totally just mess you up. So this company, PMCB, I probably got in like right here. Like, okay, so this shows 990. That was what it closed at that day, but I was probably in about here. I was in at about 8. So I got in, I was like, you know what? There's another company that was very similar to what PMCB was. And the week before, that company had gone from like 3 something to 9 something, then from like 9 something to 30 something. And I was like, hey, that could easily happen here. Let me get in. And I did get in, and I can laugh about it now, but it was sad whenever it happened. I got in, and then this is horrible. Like in the morning time, it started coming back up, pre-market, before the market opened. It started coming back up, and I was like, yes, I made a great decision. This is wonderful. And then all of a sudden, it dropped, and it went to, it was like probably like 5 something. And then it dropped some more, and I was like, I wonder what's happening. And like I went to look, and it was an offering. And I was like, you know what? It's too late for me to get out now. I'll just hold on. That was a bad decision too. I held on thinking, okay, well, it'll come back up off of this. It's sold too much, blah, blah, blah. And here is where it ended at that day, 348. And then it kind of came back up, 366 you see here. And I was like, well, it should still come back up to like 4 at least, 4 or 5. And my thought process was what they had done was they sold to, they did a private placement with some company, and then they didn't even name the company, and it was so frustrating. They didn't name the company that they sold it to in the SEC filing, but they did a private placement selling shares at, they sold shares at $5. So I kept on thinking, okay, well, eventually they've got to come back up to 5 then, since they sold these shares at 5. And also I misunderstood reading it. I thought that it meant that they didn't sell the shares until it hit 5. And I don't know why I thought that. I was totally messed up though. And I was totally wrong. And what ended up happening was, obviously what that company did was sell. They bought all these shares at 5, sold them at the 8 or 9 once the announcement, before the announcement was made. Then the announcement was made and it was already too late. Like I lost like so much. And I think by the time I actually was like, okay, I can't hold this anymore, it was like down here somewhere, like 340, 330. And I was like, I can't keep on holding this. And so I just really cut my losses. But oh, it was so painful. So I'm doing this video to kind of tell you, if you are getting into stocks, be aware that there's something called a public offering or a private placement offering of stock. And so you don't want to, if you are planning on just trading, or even if you're not, just keep a lookout on what the company is doing before you get into a stock, because they can unleash something like this, and it's very, very painful, and you don't want to get stuck in that, because it's horrible. It feels horrible. It's the worst. And companies do it, and they raise funds, and sometimes they raise funds and never even see a return. If you're looking at PMCB, they never ever come back. It's just like a year later. Like, this is what's happening in August, and now we're in about to go in January, and they still haven't recovered. So just know that this happens, and be prepared. If it happens and you happen to be stuck, if it's already too late, cut your losses. Just cut your losses. This isn't financial advice, but if it's me, if it ever happens to me again, for one, if I'm planning on trading a stock, I'm not holding overnight. For two, if I do end up getting stuck in a stock that does an offering by chance, I'm cutting my losses and just getting out. I don't want to experience anything like that again. And I can make more money trading with whatever I cut my losses with than just holding and hoping that that thing comes back, because usually that thing just continues to drop. So anyway, that's just something I wanted to share. I wanted to, because I know some people are coming and subscribing to the channel here, and this is information that's important. I want you to know, pay attention, because that happens. If it's already happened to you and you're just finding this video, cut your losses. Again, not financial advice, but if it's me, I'm cutting my losses and just getting out, because I don't want to take a chance on it going lower, because more and more people sell out and then them not ever recovering and then just being stuck in it. So, okay, just my opinion. All right, I love you all so much. If you haven't yet, be sure to subscribe, and I'll see you all very soon. Bye. Mwah.